Gold is pushing toward $4,900. The IMF is warning about a stagflation scenario, and yet stocks are going up. One of these markets is wrong. In this video, I'll show you exactly which one I'm betting against and how I'm positioning for the next 72 hours. We're breaking this into three parts: the IMF's hidden warning, the stock market trap, and the real message behind gold. The IMF just cut 2026 global growth to 3.1%, but the real warning is the downside scenario: 2.5% growth with inflation above 5%. That's stagflation: slow growth, high inflation, and very limited policy options. Central banks like the Federal Reserve and the European Central Bank are stuck. They can't cut rates aggressively because inflation risk is still driven by oil. Brent is holding between $85 and $90, and with the Strait of Hormuz at risk, this is not going away. So this is not a growth market. This is an inflation market. My approach: stay exposed to energy and commodities, reduce exposure to margin-sensitive sectors like transport and consumer. Now, here's the contradiction. The S&P 500 is moving higher, but this is not a real rally. This is short covering. Positions built during the war panic are now being unwound. The bond market tells a different story. The 10-year yield is stuck near 4.3%. No sign of aggressive rate cuts. That means this rally has limits. My strategy: do not chase this move. Use strength to reduce risk. Now look at gold. It's approaching $4,900 with explosive momentum. This is not just fear. This is a stagflation hedge. And the key signal: gold is rising while the dollar stays strong. That divergence tells you something critical. Markets are losing confidence in central banks' ability to control inflation. My approach: hold gold as a core position. Don't chase spikes, add on pullbacks. Let's simplify the entire market. Stocks are pricing hope. Bonds are pricing reality. Gold is pricing risk. And right now, gold is the signal I trust most. My playbook: watch oil. A move toward $100 changes everything. Avoid chasing equities. Stay defensive with commodities, energy, and cash. At these yield levels, cash is a position. Now, the key question: are you buying this rally or preparing for the next move down? I'll see you in the next one.